Let's get some reaction. I want to bring in Tom Lee. He's the chief equity strategist at JPMorgan. He has one of the most bullish forecasts on the S&P 500 with a forecast of 1430. So, Tom, we just heard from Mr. Guyad, and he says we're getting ready for the great reallocation at hand. He says a lot of investors, retail investors, have been aside. You and I have talked before.
Yes.
I know you've got a pretty upbeat outlook. You agree with what he's saying?
Yeah, I mean, I would agree. I mean, I think, something that's been puzzling about this rally that's started March '09, it's basically a 3-year bull market so far.
Yeah, not too bad.
Yeah, is that the public really hasn't participated. They've pulled $300 billion out of the equity markets over the last 3 years. And then trading volumes are low, which means the institutions really haven't been participating in this rally either. Institutional volumes actually continue to shrink. It's pretty consistent with what happened in '74 and actually after the 2000 sort of internet bubble peak, which means it does take some time for investors to come back.
Even with, and I know you and I have gone round and round a little bit on this already over the last week or so, but housing still maybe not getting worse, but still going to maybe stay not so great for a while. We'll have to see how the labor data, if it continues to uptrend like we've seen. I mean, there's still some concerns. Europe is still a concern out there.
Correct. That's right. I mean, I think if we're thinking about the short term sort of more tactically, I think you're absolutely right. Housing is uneven. We do think it's really going to break out because of housing, pent-up household formation, other people living in their basements.
Even though maybe more supply will come on the market as maybe banks start to release some homes maybe next year or so.
That's right. I mean, one thing we have to remember is when you look at housing's value as a percentage of GDP, it's the lowest level in 50 years.
Which tells you why?
Which just tells us that when we think about the upturn in housing, and it takes us back to trend, in other words, home prices appreciate, you're going to have not only the tailwind of house building take place, you're going to have this huge tailwind of a 3 standard deviation rise in household equity wealth.
Right.
So there's a lot of reinforcement that comes when the recovery takes place.
But Tom, when it comes to housing, I mean, the levels that we were at right before the housing crisis, I mean, were those realistic? I mean, are those the levels you expect to get back to?
I think that when we look at the history of housing, it was probably a little unusual that from '90 to '07 you had almost a steady annual increase in starts. But the fact that you get to 2 million starts is pretty normal in a housing cycle. That level has been reached, I think 8 times since 1960. So I think we will hit 2 million at some point, actually.
What about in terms of price appreciation? Will we get to the price appreciation levels that we saw?
Yes, I think with inflation we'll take out the old highs in housing, yes, eventually.
Eventually. 5 years, 10 years, might take some time.
Yeah, I mean, in some markets it's going to be a lot sooner. I mean, I think probably the typical market is probably a decade cycle, so it's going to be fair to expect it to take 10 years.
So it's not that different this time around?
Yeah, I think what's going to be different is maybe it's going to take longer to ignite for housing.
Okay.
Yeah, but you're right, it's a short-term headwind.
When you were on radio with me last week on Surveillance with Ken Pruitt, you said you were rethinking about your S&P forecast, maybe making it higher. It's right now at 1430.
Yeah.
The S&P is around 1408.
Correct.
Is it the time to do it?
It's going to make sense to do it sometime between now and year end if we're going to raise our targets.
That's a long time.
Yeah. I do think in the short term, especially when we look at Q2, I think there are headwinds developing.
Yeah.
So it may not be a time to say plow money in at levels today, but to really use any weakness in the next 3 months to buy pullbacks.
I mean, you'd like to see a correction here, a little bit of a correction?
Yes, definitely. I think not only us, I think every investor would. And something's pretty interesting that's come up in the last few weeks is more investors are talking about how their existing ideas have worked so well, they're looking for excuses to sell. So instead of saying, like, I'm sitting on a bunch of names that need to go up, they've got names that work.
It's interesting that you say existing ideas because you guys still like financials, correct?
Correct, yes.
And they've had a great run.
Yes.
An existing idea, though, that you still think has some more room.
Yeah,
there.
absolutely, because one, financials are still underowned. We can tell in our meetings investors really don't want to buy them. They think it's been a dead cat bounce. They're a big beneficiary of housing recovery. They're really a name that works well if Europe recovers. And then, of course, as far as valuation, still close to 40-year lows on valuation.
I asked you about your forecast. I'll let you get off. I'll wait to see what you do on that. But, I mean, the S&P is up 12%. Is that the kind of gain you think we'll have? I mean, if we get a correction, are you saying that we're up 12% by the end of the year then, ultimately, or even stronger than that?
It's, Carol, it's a good question. I think in some ways, and this is something we wrote about in December when we thought about 2012, is that we thought 2012 would look a lot like '09, which was a post-financial crisis year.
Yeah.
And we have to remember, think back about 6 months ago, people thought the world was ending. They got very defensive. In the meantime, corporate cash balances have been swelling. the news has been pretty good out of businesses. They've got a lot of cash. I think it means, it easily could be a good double-digit year for stocks.
And you expect that 200,000 job creation in private payrolls, you expect that to continue?
That's right. In fact, it may actually start picking up some momentum.
How much, Tom?
I think that this is very likely a 3 million jobs year.
Wow.
So, 250 to 300,000 a month will be the pace of jobs growth.
And the unemployment rate goes down too?
Well, that's going to be interesting, but I think there is going to be a drift downwards in the unemployment rate. 7% is the level that you got to start thinking about tightening. So I don't think we're going to hit 7 this year, but I think it's very likely we could hit 7% unemployment in the next couple of years.
Anything out there though that would make you change your optimistic outlook at this point? Drastically.
I think that I think probably the most difficult issue to get around is if oil gets to levels that cause global economic weakness, and I don't know the level. It's probably 150. But as you know, you look at a lot of countries that are big users of oil, it's going to really hurt them hard.
And demand isn't going down.
Correct. And there's still some political uncertainty in the Middle East, so you got geopolitical risk as well.
What about political risk here in the United States? Once we get through the elections and what we see in terms of Congress and having to put through a lot of measures, we've got a couple of deadlines dealing certainly with the deficit come year end.
Correct.
Peter Corey was on yesterday, Bloomberg Business Week, and he's watching them closely, that this could be very problematic, he says, for the economy and economic growth. Yeah. If we miss those deadlines.
Yeah, it's possible. As we looked at what happened last year, capital markets really bully Congress into acting. So I think that if there is a crisis, it's really short-lived, right? Last year, the lesson was you probably shouldn't sell in the panic. Right. You should be buying that panic. But I think when people talk about tax rates, I think they're overestimating the hit to the economy from higher tax rates.
You're sure about that?
Well, I will cite some precedents. When we look at 62, the mid-70s, even 93, marginal tax rates in those years rose 500 basis points or more, which is similar to what we're facing. GDP growth was above trend each of those years. So you feel pretty confident? You're not too worried? Well, I think we're overstating the risk from higher tax rates. All right. All right, and you don't want to change your target right here and now? 1430, you don't want to switch it? I think if the S&P was down like 100 points today, I think it'd be a great day to raise the target, right? All right, so we should come back to you when we see some kind of correction, maybe. Yes. All right, we're going to leave there. Tom, thank you. Carol, great to see you. Great to see you always. Yeah. Tom Lee.